Hi, welcome back. I want to start today with a simple question, and I want you to actually think about it before I give you the answer. If your grandfather earned $100 back in 1971 and put that money under his mattress, and you found that same $100 bill today, how much would it actually be worth? Most people guess it would buy a lot less because of inflation, and that's true. But here's what really surprises people. If instead of holding that paper dollar, your grandfather had converted it into gold, the story would look completely different. That difference, the gap between what a dollar buys and what gold buys, is what we're going to unpack today. And by the end of this video, you're going to understand something that most working professionals never learn in school, which is why your salary, no matter how much it has grown over the decades, buys dramatically less gold today than it did 50 years ago. Now, this matters right now in 2026, more than at almost any other point in recent memory. We're living through a period where central banks around the world are buying gold at a pace not seen in generations, where everyday people are quietly asking whether their savings are keeping up with the cost of living, and where the value of paper money itself is being questioned in ways it hasn't been for decades. So understanding this history isn't just an academic exercise. It's a lens that helps you make sense of what's happening with prices, wages, and wealth today. Let's go back to 1971 for a moment, because that year is the hinge point for this entire story. Before that year, the U.S. dollar was connected to gold in a formal way. Other countries could exchange their dollars for gold at a fixed rate. This system had been in place since the end of World War II, and it gave the dollar a kind of built-in discipline. The government couldn't print unlimited amounts of currency because, in theory, every dollar in circulation was backed by a promise that it could be converted into a fixed amount of gold. Then, in August of that year, the president at the time announced that the United States would no longer honor that promise. This decision, often referred to as closing the gold window, effectively cut the last thread connecting the dollar to gold. From that point forward, the dollar became what economists call a fiat currency, meaning its value comes purely from trust and government decree, not from being backed by a physical asset. Here's what this means in practical terms. Before 1971, there was a natural limit on how much money could be created, because it had to correspond, at least loosely, to the gold reserves backing it. After 1971, that limit disappeared. Governments and central banks gained the ability to expand the money supply far more freely. And when you increase the supply of something without a matching increase in the goods and services it can buy, basic economics tells us the value of each individual unit tends to decline over time. That's the essence of monetary inflation, and it's the quiet force that has been eating away at the purchasing power of the dollar for over 5 decades. Now, let's make this concrete with numbers, because abstract concepts are much easier to understand with a real comparison. In 1971, the price of gold was fixed at around $35 per ounce. Today, in 2026, gold trades at a price many multiples higher than that. Think about it this way. If you had 1 ounce of gold in 1971, it could have been exchanged for about $35. That same ounce of gold today would be worth dramatically more in dollar terms. Meanwhile, if you had simply held onto that original $35 in cash instead of converting it to gold, its purchasing power today would be a small fraction of what it once was. You'd need many, many more of those dollars just to buy the basic goods that $35 could buy back then, things like groceries, gasoline, or a modest dinner out. This is the core of what people mean when they say the dollar has lost the vast majority of its value since the gold standard ended. Let's bring this closer to home with something everyone can relate to, which is wages. Imagine a worker in 1971 earning what was considered a solid, respectable salary for that era. If we translate that salary into how many ounces of gold it could purchase annually, and then we compare that to a modern salary translated into gold, using today's price, something striking happens. Even though nominal salaries have gone up significantly over the decades, meaning the actual number on your paycheck looks much bigger than it did in 1971, when you measure that salary in terms of gold rather than dollars, it tells a very different story. Many studies and long-term data comparisons suggest that the average salary today, when converted into gold, buys somewhere in the range of 80 to 90% less gold than a comparable salary could purchase back in 1971. Now, this is important because it reveals something your paycheck doesn't show you directly. Your dollar income might look like it's grown, but measured against an asset that has historically preserved value across centuries and civilizations, your real purchasing power has shrunk substantially. So why does this happen? Let's break this down step by step, because understanding the mechanism helps you understand the outcome. Every year, governments run budgets, and often they spend more than they collect in taxes. To cover that gap, they borrow money, and central banks play a role in managing that debt and the broader money supply. Over decades, this has meant a steady expansion of dollars in circulation, more dollars chasing the same amount of goods, services, and assets naturally pushes prices upward over time. This is why a loaf of bread, a gallon of gas, or a monthly rent payment all cost more today than they did decades ago. Your salary has increased in nominal terms partly to compensate for this, but the increase in wages has often lagged behind the true expansion of the money supply. Gold, on the other hand, cannot be printed. Its supply grows slowly and predictably through mining, at a pace of roughly 1 to 2% per year globally. Because gold's supply is naturally constrained while the dollar supply has expanded so dramatically, gold has effectively acted as a mirror, reflecting just how much the dollar has been diluted. Think about it this way. Picture a large pizza that represents the total wealth and value in an economy. If you cut that pizza into 8 slices, each slice represents a meaningful portion of the whole. But if you keep cutting that same pizza into smaller and smaller slices, say 32 slices instead of 8, each individual slice becomes much smaller, even though the pizza itself hasn't grown. This is roughly what happens to the dollar over time. The number of dollar slices keeps increasing, but the total value of goods and services in the real economy doesn't grow at nearly the same pace. So each dollar slice becomes worth less. Gold, by contrast, is like a pizza that barely gets cut into more pieces at all, so each slice retains much more of its relative size and value. Now, before we go further, if you're finding this breakdown helpful, it would mean a lot if you hit that like button and consider subscribing to the channel. We put together content like this regularly to help everyday people understand the financial world around them, without the jargon and without the noise. It genuinely helps the channel grow when you engage with the video, so thank you if you've already done that. Let's talk about something happening right now that connects directly to this whole story, and that's the behavior of central banks around the world. Over the past several years, central banks in countries like China, Russia, India, Poland, and several others have been purchasing gold reserves at a historic pace, often exceeding 1,000 tons collectively per year. This is a meaningful shift because for decades following the end of the gold standard, many central banks were net sellers of gold or held relatively stable reserves. The renewed and aggressive buying suggests that many nations are hedging against the same currency dilution we've been discussing, essentially protecting their reserves by holding an asset that can't be printed or devalued by policy decisions. This doesn't mean gold is about to replace the dollar as the world's primary currency, and it would be misleading to suggest that. The dollar remains the dominant reserve currency globally, used in the vast majority of international trade and held by nations everywhere. But the trend of central bank gold buying does tell us something important about how major financial institutions are thinking about long-term value preservation, and it's worth paying attention to as an indicator of broader sentiment. It's also worth acknowledging the other side of this conversation, because a responsible breakdown should include different perspectives. Some economists argue that comparing salaries to gold isn't the most useful way to measure standard of living, because gold prices themselves can be volatile and are influenced by speculation, investor sentiment, and short-term market cycles, not just long-term currency debasement. They point out that when you measure living standards through other lenses, like access to technology, healthcare improvements, or the affordability of certain consumer goods, life in many respects has improved significantly since 1971, even if the gold comparison looks stark. This is a fair point, and it's important to hold both ideas at the same time. Gold purchasing power is one lens, a powerful one, but not the only lens through which to view economic progress. So how should you think about all of this in a simple, practical way? Here's a mental framework that might help. Imagine your wealth measured in 3 different containers. The first container is your income, which is measured in dollars and tends to rise slowly over your career. The second container is your expenses, which also rise over time due to inflation, sometimes faster than your income. And the third container is your savings, however you choose to hold them, whether in cash, in a retirement account, in real estate, or in some allocation toward assets like gold. Understanding the relationship between these 3 containers and how inflation quietly reshapes the size of each one over the decades gives you a much clearer picture of your real financial position than simply looking at your salary number in isolation. Looking ahead, it's reasonable to expect that some of these long-term trends will continue, though the pace and intensity are genuinely uncertain, and nobody can predict market movements with certainty. Government debt levels in the United States and many other developed nations remain historically high, and managing that debt often involves some combination of economic growth, spending adjustments, and monetary policy that can influence currency value over time. Central bank gold accumulation appears likely to continue in the near term based on stated policy goals from several nations, though this could shift depending on global economic and political conditions. What we can say with more confidence is that understanding the historical relationship between currency creation and purchasing power gives you a useful framework for interpreting economic news as it unfolds, rather than reacting to headlines without context. Bringing this back to your everyday life, this conversation matters because it shapes how you think about saving, budgeting, and planning for the future. If you're only measuring your financial progress in dollar terms, you might feel like you're getting ahead simply because your salary number is higher than it was 5 or 10 years ago. But if prices for housing, education, healthcare, and everyday goods have risen just as fast or faster, that nominal progress can be an illusion. Being aware of this dynamic doesn't mean panicking or making dramatic changes to your finances. It simply means approaching your financial decisions with a clearer, more complete picture of how money actually behaves over long periods of time. So let's bring this all together. Since 1971, when the dollar was fully separated from gold, the purchasing power of the dollar has declined dramatically. And when you measure a modern salary against gold rather than against its own nominal value, that salary buys a fraction of what an equivalent salary could purchase back then, somewhere in the range of 80 to 90% less by many estimates. This happened because the supply of dollars has expanded consistently over decades, while the supply of gold has grown slowly and predictably, making gold a kind of mirror that reflects the true scale of currency dilution. Central banks around the world seem to understand this dynamic well, given their renewed and historic pace of gold accumulation in recent years. None of this is meant to alarm you or push you toward any specific financial decision. It's simply meant to give you a clearer lens, a better set of tools for understanding why money feels the way it feels, and why your grandparents' stories about prices from decades ago aren't just nostalgia, They're a reflection of a very real, measurable shift in the value of the currency we all use every day. Thank you for watching this breakdown all the way through. If it helped you see this topic a little more clearly, consider subscribing so you don't miss future videos where we continue exploring how money, history, and markets connect to the financial decisions you make every day. I'll see you in the next one.